Hey there everyone, and welcome back to the channel. Today, we're doing a deep dive into something that's fundamental to building wealth: understanding asset classes. You've probably heard terms like stocks, bonds, and real estate thrown around. But what do they actually mean? And more importantly, how do you choose the right ones for your financial goals? Stick around, because we're going to break it all down, step by step, making it super simple to understand. So, what exactly is an asset class? Think of it as a category of investments that share similar characteristics. They behave similarly in the marketplace and are subject to the same laws and regulations. The main reason we group them is to build a diversified portfolio. You know the old saying, "Don't put all your eggs in one basket"? That's the core idea here. By spreading your money across different asset classes, you can reduce your overall risk. Let's start with the one everyone knows: stocks, also known as equities. When you buy a stock, you're buying a small piece of ownership in a public company, like Apple or Amazon. If the company does well, the value of your stock can go up, and you might also receive payments called dividends. This potential for high growth is what makes stocks so attractive. Historically, they've offered some of the best long-term returns. But, and this is a big but, they also come with higher risk. Stock prices can be volatile, meaning they can go up and down dramatically in the short term. If the company performs poorly or the overall market takes a hit, you could lose money. So, stocks are great for growth, but you need to be comfortable with some ups and downs. Next up, we have bonds, which are also called fixed income securities. When you buy a bond, you're essentially lending money to an entity, which could be a government or a corporation. In return for your loan, they promise to pay you periodic interest payments over a set period, and then return your original investment, the principal, at the end of the term. Bonds are generally considered safer than stocks. Why? Because their returns are more predictable. You know how much interest you're going to get. This makes them a great tool for preserving capital and generating a steady income stream. However, their lower risk usually means lower potential returns compared to stocks. Bonds are a stabilizing force in a portfolio, helping to cushion the blow when the stock market gets rocky. Now, let's talk about something you can physically touch: real estate. This includes buying a property to rent out, investing in commercial buildings, or even just owning your own home. Real estate can be a fantastic investment. It can provide a regular rental income, and the property's value can appreciate over time. Plus, you get certain tax benefits. It's a tangible asset, which many people find comforting. The downside: real estate is a liquid. That means you can't sell it quickly like you can a stock. Selling a house can take months. It also requires a significant amount of capital to get started, and there are ongoing costs like maintenance, property taxes, and insurance. So while it can be very rewarding, it's a big commitment. Another popular category is commodities. This is a broad group that includes things like gold, silver, oil, and agricultural products like wheat and coffee. People often invest in commodities to hedge against inflation. For example, the price of gold often goes up when the purchasing power of money goes down. They can also be a good way to diversify because their prices don't always move in the same direction as stocks and bonds. However, commodities can be extremely volatile. Their prices are driven by global supply and demand, geopolitical events, and even whether they don't generate income like dividends or interest. So your only return comes from price appreciation. It's a high-risk, high-reward game that's usually for more experienced investors. Finally, let's touch on cash and cash equivalents. This is the simplest and safest asset class. It includes the money in your savings account, certificates of deposit, or money market funds. The main purpose of holding cash is safety and liquidity. It's your emergency fund, the money you can access immediately when you need it. The risk is virtually zero. However, the return is also very low, and often it doesn't even keep up with inflation. This means that over time, the purchasing power of your cash can actually decrease. So, while it's crucial to have some cash on hand, you don't want to keep all your long-term investment money here, or you'll miss out on growth. So, how do all these pieces fit together? The key is asset allocation. This is just a fancy term for deciding what percentage of your money goes into each asset class. Your ideal asset allocation depends on three main things: your financial goals, your time horizon, and your risk tolerance. Let's break that down. First, your goals. Are you saving for a down payment on a house in 5 years? Or are you saving for retirement in 30 years? Shorter-term goals require a more conservative approach. You can't afford to lose that down payment money, so you might lean more towards bonds and cash. For long-term goals like retirement, you have more time to recover from market downturns, so you can afford to take on more risk with a higher allocation to stocks. Second, your time horizon. This is directly linked to your goals. The longer your time horizon, the more aggressively you can invest. A 25-year-old investing for retirement has decades to let their investments grow and ride out the market S-bumps. A 60-year-old who is about to retire needs to protect their capital and will have a much higher allocation to safer assets, like bonds. And third, your risk tolerance. This is more of a personal, psychological factor. How would you feel if your portfolio dropped by 20% in a month? Would you panic and sell everything? Or would you see it as a buying opportunity? Being honest with yourself about how much risk you can stomach is crucial. If you take on too much risk, you might make emotional decisions that hurt your long-term returns. If you're too conservative, you might not reach your financial goals. There are many online questionnaires that can help you figure out your risk profile. A common example for a young investor might be a portfolio with 80% stocks and 20% bonds. This is aggressive and focused on growth. For someone nearing retirement, it might be the opposite, maybe 30% stocks and 70% bonds, focused on income and preservation. These are just examples, not advice. Your personal mix will be unique to you. The magic of this is at least once a year, you should review your portfolio. Let's say your target was 80% stocks and 20% bonds. If stocks had a great year, your portfolio might now be 85% stocks and 15% bonds. To rebalance, you would sell some stocks and buy some bonds to get back to your 80-20 target. This forces you to sell high and buy low, which is a disciplined way to manage your investments. Remember, investing is a marathon, not a sprint. The goal is not to get rich quick, but to build wealth steadily over time. Understanding these asset classes is your first, most important step. Don't feel overwhelmed. Start small, educate yourself, and build a plan that works for you. The most successful investors are the ones who stay consistent and don't let fear or greed drive their decisions. I hope this breakdown was helpful and demystified the world of asset classes for you. Building a diversified portfolio is the bedrock of a sound investment strategy. If you found this video useful, please give it a thumbs up, and don't forget to subscribe for more content on personal finance and investing. Let me know in the comments which asset class you're most interested in learning more about. Thanks for watching, and I'll see you in the next one.